is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott, here with co-host Andrew Young. Andrew, we're recording this on Tuesday, April 30th, towards the end of the day. If the market holds where it is, this is going to be the worst month for stocks for this year and the worst month for crypto since the collapse of FTX. I don't know if you've realized this, but we actually were coming off of such a high towards the end of March that even this fairly modest drawdown has actually been the worst period since the collapse of FTX in the fall of 2022. To put it into context, it's been a pretty modest pullback. Bitcoin hit an all-time high around $73,000. Right now, it's a little over 60K. So we're talking like 15 to 20%. I think we've talked about this on the show, but I've certainly reported in our weekly note that every single run-up to all-time highs has typically been preceded by several bull drawdowns where, in the bull channel, you still have periods where the price declines. In fact, in the last cycle, we had 4 of these leading up to all-time highs. So I think you share my view that you're still constructive on this market. The month after the halving is usually kind of choppy. And now we've got some headwinds in the general macro space because of the changing sentiment around interest rates, maybe not getting cut as much or even at all this year. And so that's just putting a little bit of pressure on the market as a whole. And then this week, we also had the Hong Kong launch of Bitcoin and Ethereum ETFs. I think if it weren't for the promoter coming out and saying it was going to be a $300 million day for the products, that the market wouldn't have reacted as negatively as it did. But what happened basically is he came out with 300 million, and what we ended up getting instead was about, I think, 10 or $15 million of volume. So underperformed.
Really? Wow.
Underperformed his expectations, but all the ETF commentators will say, for the Hong Kong market, which is frankly not a very big or deep market and has no track record or legacy crypto asset products, this was actually a huge success and translates into almost $1.6 billion equivalent if it were a US listing. It just so happens that it's a tiny market. And so the numbers should be correspondingly small. Even still, we're seeing the markets kind of selling off here, and we're just in this sort of downward channel within the broader uptrend. So yeah, before we get into some deep topics, and there's a lot of juicy stuff to talk about this week on the news side, what's your take on just where we're at in the market?
Yeah, it's interesting. I mean, I think the sentiment is really poor, I would say, within the crypto trading community. I think for the most part, because people are so long, extremely high beta, like meme coins, things like that, which have just been getting crushed in the last little bit. It hasn't really been, It's mostly been like a crab market. You know what I mean? It's just kind of been sideways. Some things have been doing well. Some things have been doing poorly. I think like where the sentiment is the worst is actually on Ethereum. Like just Ethereum continually has been underperforming. And it's really just continuing to get kind of squeezed between the outperformance of Bitcoin at the higher end, as well as the outperformance of like Solana, as well as like all the really high beta meme coin stuff. So I think one thing we've been right about though is just the torrential inflow of new meme coins has kind of saturated that market. You literally have websites like pump.fun, for example, which is like kind of recently launched product that essentially makes it incredibly easy to just launch your own meme coins. And you go to the site and there'll be like 10 new ones created in every like couple minutes. So I think like it's just like there's so many the meme coin supply is crazy, which is great. I mean, I'm happy to see meme coins start to die down a little bit, at least like the pure, nothing going to be created out of them kind of meme coins. But yeah, so I think overall, very constructive. I think like the next, I think we probably will be continue to be in this sort of crabby sideways market for the next couple months. And then my guess is still sort of second half of this year, we really start to see a big sort of increase as we get ready for like essentially the second leg of the bull market, which historically bull markets have kind of come in these different waves.
Yeah, I'm with you. I think 2 or 3 weeks ago, we recorded an episode about meme coin mania, where I basically said, I don't get meme coins, but maybe I'm just a boomer. And I think pretty sure that episode was the top tick of the market in meme coins. And it's all been downhill since then. And look, I mean, there are some of these things that have been around for years and they have communities and people buy them and own them, and that makes them happy. And so I think that there's probably a path forward for these things, but there's just no way that the market can sustain thousands of worthless, meaningless assets. It would be so interesting actually to really know how many crypto assets exist in the world today. I don't know if there's a way of figuring that out, but it's now got to be, hundreds of thousands, if not millions. And the vast majority of these have no value. As it relates to the market overall, yeah, I'm with you. I don't know. I'm not really fussed, frankly, about what's going on. There's still been pretty balanced flows into these ETFs. Obviously, the Grayscale ETF continues to lose some assets, but overall, things have been pretty balanced. This Hong Kong number, notwithstanding this promoter, actually was pretty decent. And, we're starting to see, or rather, we continue to see lots of positive signs that stuff's, happening. There's adoption going on and so forth. Franklin Templeton launched a tokenized treasury fund. BlackRock's tokenized treasury fund is apparently doing very, very well. Stripe just announced that they're reintegrating crypto. They tried it 6 years ago with, I think, Bitcoin, and are doing it again with USDC, with what I imagine will be a lot more success because they're a payments company, and crypto and stable coins are a payment tool. Bitcoin is more of a savings tool, as we've discussed. So yeah, I mean, I don't know, every other day there's some sort of major news event that or sort of big catalyst or big announcement, at least, that says to me that it's sort of full steam ahead. So yeah, I think that's kind of where we're at the moment. Now, the big news this week, though, was around this project, and I'll let you explain a little bit what happened. But basically, it's this project called EigenLayer. Now, EigenLayer, I think a lot of people who listen to the show know about it if they're in the crypto world. Probably they don't. And it all kind of comes down to this concept of staking. So I think we've discussed in the past how Bitcoin uses a system called proof of work, which is energy intensive. Miners provide computing power to the network, and the ones that are able to basically validate a block first earn a reward paid out in Bitcoin, and that's paid out periodically over time. The staking system, basically, the more of an asset that you own and stake to the network, basically pledge, the more you can earn as a result by basically helping to provide security. And in a proof of stake system, instead of gaining 51% of the computing power to attack the network, you basically gain 51% of the assets staked. So basically, in other words, the more assets that are staked to a network, the more secure it is. And Ethereum is a proof of stake network that has the most assets secured to it than any other because it's the biggest. Now, the question is, while all these new projects are launching and there's proof of stake networks, how do they get to sort of a critical mass of assets where trying to take over that network would be very difficult to do? How is it that they reach sort of a certain level of security? And so some very clever people last year basically figured out, well, they've been working on it for longer, that, well, maybe you can try and use the ETH that is staked to the main network and restake it to a new project or protocol in order to basically share the security from the staked ETH to the mainnet. And I gather that EigenLayer is sort of like the biggest player in the space and has been very successful in basically driving the restaking of ETH to other kinds of projects. So I'll stop there because we're getting into some serious, inside baseball, and you're very good at explaining that. So why don't you tell us a little bit about EigenLayer, just like from when it launched, I think it was last summer or last fall, to today, and then what happened this week that's got everybody buzzing.
Yeah, totally. So yeah, exactly like you said, essentially allows you to reuse staked ETH to effectively secure other networks. And as of right now, I think at its peak it hit $16 billion in TVL, which would make it one of the sort of top 5 TVL protocols in the world. And it's also captured, I'd say, like a lot of the narrative about like people are extremely excited about restaking. And in a way, it kind of like allows you to reuse. I mean, it's restaking, right? So you get to reuse your staked ETH to earn even more yield on top of it. And so, anyways, what was interesting with EigenLayer is that they didn't have a token.
That in addition to it being a way to provide shared network security, obviously as a holder of ETH, if you've got ETH staked to the main net, you're earning like I think 3 to 4%, which is sort of like, as you've said on the show, like the risk-free rate for the crypto industry. But why not take those assets and try and use them as a way to earn more somewhere else? And not an exact analogy, but it's like if you owned a rental property and then you got a line of credit against it to go buy, bonds, and that paid additional yield or something like that. I don't know. That's an imprecise analogy, but it's like reusing an asset, generate additional return.
That's a pretty good sort of analogy. Some people have also compared it to like rehypothecation, which is sort of like another TradFi analogy you could sort of use to of just like reusing collateral. But so what was interesting, so like the yield from using EigenLayer, essentially the reason why everyone was putting $16 billion of staked ETH into this thing, because there is risk with it, right? Like EigenLayer, the smart contract could get hacked, and you would effectively lose all your ETH. And so the reason why was because EigenLayer didn't have a token, and so everyone was really excited because like as you staked ETH into this thing, you effectively accumulated what are called points, which has kind of become like the new. We can talk about that too, but you effectively got these EigenLayer points, which weren't. I don't think they were explicitly said that they would become airdrop tokens of EigenLayer, but effectively strongly hinted towards that. And so so everyone was essentially just farming this protocol. So farming is generating yield from this, and getting really excited about this airdrop. And so the EigenLayer airdrop was finally announced yesterday. And to give you some context, there's been a sort of a string of other airdrops in the last month that have been relatively disappointing. So everyone was kind of hoping that both the airdrop would kind of renew the sort of like demand for people to keep doing this airdrop hunting, but then also could provide like a bullish catalyst for ETH, because obviously EigenLayer is effectively built around ETH. And
totally.
I would say the early returns after one day are that the airdrop was, quote, incredibly disappointing. It was actually so bad on this. The EigenLayer sort of founders were on a podcast yesterday, and they had to turn off the comments live stream because it was just constant comments calling it like a scam. Which it's not a scam, obviously, but anyways, the reason why everyone was so disappointed was that first they had incredibly like anyone was able to deposit their ETH into EigenLayer to essentially restake, but when you went to go claim, there was a ton of countries that were geo-blocked. So essentially, you could deposit ETH into EigenLayer from Canada, but then when you go to claim your rewards, Canada was geo-blocked, likely due to some securities law concerns, just because of like the sort of unsure regulatory environment of airdrops in Canada. So, and there's about like 15 other countries where that was the case. So that left a really bad taste in a lot of people's mouth, because if you're going to geo-block the airdrop, you sort of have to geo-block the like depositing of collateral into it. In a way, it's kind of unfair to let people lock up their ETH to get a supposed airdrop and then prevent them from getting that airdrop just based on their country. So that was one thing. And then two was the token is also non-transferable, which is highly unusual. So the airdrop itself, when you go to claim the airdrop, you can't actually like trade the airdrop in any way. Whereas all of the insiders, i.e. core team, as well as outside investors, their tokens are transferable.
Right.
Which is also kind of just unfair, I think. Like the community essentially has essentially no tokens freely trading right when the token does come online, until it was sort of ambiguous too around when it would become transferable. reason why they're doing that is the last couple of months, airdrops have been quite disappointing. So every time a new token gets launched, it's been following kind of the similar price chart of like a new IPO, where when like new stocks typically IPO, if it's not, a hugely bullish time in the market, they sort of just crater over the first couple, 3 to 6 months. And that's been happening with a lot of these airdrop tokens. And so to try to counter that, they effectively are preventing any of the like airdrop farmers, hunters, whatever you want to call it, from selling right away. The problem is that it leads to a bit of a community revolt. And crypto projects are different than traditional businesses, where the holders of the token are both kind of like owners of the protocol, but then they're also your users at the same time. And so if you piss them off, it leads to people just hating your products at the same time. So that's tough. That's led to a very sort of poor perception of the project, I would say. And I think in the last 24 hours, we've seen, I believe, $600 million of withdrawals so far from the
withdrawals. Like, have they gated the withdrawals, or is that something?
No, so the withdrawals, I believe they take about a week to process. So that's like the one sort of gating item, I guess. So it looks like so far, just looking on chain, about 500 to 600 million has been withdrawn, which is actually relatively small. That's only about 3 or 4%. I would expect that to sort of continue over the next week, potentially, just based on sentiment. And what's interesting about EigenLayer is that to me, it sort of represents the end of airdrops as the new meta for getting tokens into the community's hands. So like, I can just give a quick history lesson. So crypto projects, they only really exist if you have a huge network of people that, use the network and believe in it and want to hold and stake the token to secure it. And so when crypto assets were first created, essentially the main mechanism was proof of work. So the idea was Bitcoin, there was no insider allocation to Bitcoin. You could only get Bitcoin by mining new Bitcoin, or someone obviously sending it to you. But sort of the primary issuance model was through providing compute to it. So that's like the proof of work era. The second era was effectively the ICO era. So that was like the 2017 to 2018. Effectively there,
coin offering, right?
Yeah, initial coin offering, and that was what drove a lot of Ethereum. Initially, was people could launch their own coins and raise capital from the public. That obviously led to the first kind of ICOs. Actually, a lot of them provided a pretty good return, but then obviously the market got saturated with tons of like very low quality projects that were just essentially vaporware, and that kind of got shut down by like regulatory actions. So that spawned the next era, which was during the bear market of like 2018, 2019, 2020, which was IDOs. So this was effectively, IEOs, initial exchange offerings. So these were essentially very similar to an ICO, but done through a centralized exchange like Binance or any of these other exchanges. And that had a sort of a short shelf life. And effectively, it led to the DeFi wave, where projects would effectively give tokens through liquidity mining. So from like 2020 to like 2021, that was like the main meta, whatever you want to call it, for getting tokens into the hands of the public. Was if you provide liquidity to this DeFi protocol, you earn tokens in real time. And then finally, that was getting gamed too much. So actually, primarily by huge projects like FTX, for example, they were known to be incredibly ruthless in sort of institutionally farming these protocols. And so then finally, this led to like the current meta of like the last 2 years, which is projects launch products, people use them, and then eventually at some point they do an airdrop where they airdrop tokens to users. And the initial most famously, Uniswap did this. So Uniswap issued 400 uni to pretty much anyone that had ever used Uniswap, which was like tens of thousands of people. And that was, I think, like 2021. And so, the last like 2 years, that's been the sort of the thing. And then the last like year, that was starting to get gamed as well. So then people created this whole point system where you would use these products and you would get points. And then the points effectively were an indication of how many tokens you would get. That has now, I think, reached its sort of apex now. And I think it's probably on the decline because it's kind of the point now where there's secondary markets where you can trade these points. And so it's just kind of like re-institutionalized. And that's kind of like what happens with these is like a new distribution mechanism is created. It's unique. It gets tokens in the hands of users and retail and all that type of thing. And then big players realize there's lots of money into it. They essentially institutionalize it and really like take it over. And then everyone sort of pivots to, because the problem there is like, then you don't create an organic community. You're essentially just creating a community of mercenaries. Anyways, a really long rant, but that's kind of the history of these distribution mechanisms. And I think we're probably at the end of the current one. I'm not really, I have some theories on what the next wave will be, but it's been, it's interesting to see.
Well, I'd love to hear those theories, but before you get into that, I think it'd just be helpful, to sort of explain or to talk about like, what's the point of all this? Like the idea, I think, is that, if you're a user of an application in Web3 or a user of a network, then you should be able to participate in the ownership and the upside from being part of that community. That's sort of the difference, right, between like the Web3 model and the Web2 model. In the Web2 model, you are an inert passive user of a platform and you don't earn ownership. You don't get to decide how that platform is governed, what rules it puts in place, how it treats its users. The separation of ownership and usership is very clear. In Web3, users are owners or users become owners, right? And so that concept is, in my view, incredibly powerful and I think can help to bootstrap a lot of projects that otherwise would have needed, lots of marketing money or other resources to try and build a community. So that's the plus. That's the positive side of this whole story. The downside is that people just become obsessed with and preoccupied with amassing as large a position as they can in these things without really any regard for or interest in using the underlying platform. And this is like the central challenge of Web3 applications is that, people are inherently motivated by making money in a way that is so different from other motivations. And so they will find any way they can to unlock value from projects, whether they use them or not. And I think that like going through all those different models, they were all different in different ways. Like a proof of work is you're providing security to the network. You're helping to secure the network and you have a reasonable chance of earning a reward for doing that. That was like the early Bitcoin model. That seems like a very sensible model where you're aligning the interests of major stakeholders with the network and its other users. In an ICO and an IEO, you're basically just doing an offering of an asset, security or otherwise, debatable. But you're basically selling this with the expectation that someone's going to, make some money on it. Liquidity mining, I view, is a little bit different because, at least in DeFi, applications in financial services are only as useful as the amount of users and the amount of liquidity that exists on that platform. So by providing liquidity to, like, say, a decentralized exchange, you're making that platform more useful for everybody else, and so you should be rewarded. In the airdrop version, like, I don't see what's wrong with airdrops per se, because in my view, the idea is you're a user of an application, and at some point, maybe right away or during the early stage of that project, you are going to be rewarded in some way for being an early adopter. It'd be like if, I was one of the first million people on Facebook in 2004 because my school happened to be one of the first 100 that was selected or whatever by Facebook. And in the early days, I added a lot of value, like unwittingly. I made a lot of social connections. I posted content. I scheduled events. I used Facebook quite a lot in those days. And in a Web3 model, in an ideal Web3 model, I'm doing that regardless. But then as a result, I'm getting a stake in the network because what I've done is I've helped to improve the network effects, right? And so I guess the thing is, like all of these models are not inherently flawed, but in each of them is a flaw. And the flaw, if you can describe it, is like the idea that users, you want to align the interests of users and owners, but what ends up happening is that people don't become users, they become mercenaries who are just looking for a way to make a quick buck, basically. And then once the rewards dry up, they move on to the next thing. And that seems to be a habitual process that has turned Web3 into, at its worst, turned it into kind of this just kind of crazy carnival casino, right? So I don't know. I'd love to hear your perspective on that, but also on what you think is next, because I've always said about these things, well, these are implementation challenges to be overcome. They're not reasons that, ownership is a bad idea. Of course, if you're all things being equal, if you're going to use something and create value and be useful, then you should own some part of that. But I'm trying to figure out how we overcome that challenge. So what's your take?
Yeah, I actually, it's tough to say. The funny thing is, I mean, I actually think the next meta for distribution of tokens, funny enough, is going to be meme coins. I think,
No.
yeah, yeah. I think I've been thinking about it a bit. I mean, it seems crazy, but I think the only way to solve this, again, I think this is only going to work for certain projects, but uh, and I could easily be wrong, but like for example, like Shiba Inu started as a meme coin, and it famously got really big because it airdropped something like 50% of its supply to Vitalik. The whole idea was like it wanted to be like the Dogecoin of Ethereum. And
Yes.
then Vitalik like dumped all of those tokens and gave all the money to charity. I think it was to like the Indian COVID charity that friend of the pod, Sandeep, the Polygon founder, had started. Something I think that was what it was. But anyways, and then anyways that generated tons of news, headlines, all that stuff, and it became quite big. What's interesting is the Shiba community survived this and became quite a bit larger. And now recently they actually just raised a round. So let me just find out the exact amount. Yeah, so Shiba Inu raised $12 million to launch a privacy-focused layer 3. I believe it's on top of Arbitrum. I could be wrong. And what's interesting about that is it's starting in the exact inverse of like what a crypto project is. So like up until now, most crypto projects, it's kind of going back to like the old days. So crypto projects right now, for the most part, they raise VC funds, they build a product, users use that product, they give coins to the users and build a community. A meme coin does this an exact opposite. It goes right to building a community. And then what's interesting in the case of Shiba is they actually then built products to service this community that they already built. They effectively built distribution first. They built distribution first, and then they built a product. And then now they're actually raising money from VCs. And so the easiest way to, like at the end of the day, if we're moving towards a world where tech is, increasingly commoditized, I don't think we're there yet. But in that type of world where distribution and community is everything, then it actually makes a lot of sense to start with a meme coin first, because meme coins inherently, they launch at an incredibly low market cap. So it builds this like meme coins for the most part always have better communities than products because, they effectively go public, whatever you want to call it, at a much earlier. And it's more built around like an idea and the community itself versus like any specific utility. So my contrarian idea is that I think meme coins could be the next wave, particularly for consumer apps, because I think VCs will pretty much always fund infrastructure. That makes too much sense. Infrastructure is, you need to have an incredible technical team. But for consumer apps where it's more about like marketing and distribution, in like the current crypto world, we're sort of awash in infrastructure to the point where like launching your own roll up, which is like a layer 2 or a layer 3. You can now do that like without even having to code. Like there's projects like Conduit where you literally, it's just like a no code tool to launch your own roll up in seconds. So anyways, in a world where infrastructure is commoditized, I think we're moving towards a world where consumer apps, the tech will be somewhat not commoditized, but it'll be possible for people to like white label and do things like that. Then distribution and community become king, and there's no better way to build that, at least at the moment, than meme coins. So maybe that's maybe that's just me hoping that meme coins become real. I don't know, but yeah, it could be interesting.
Well, I like the idea. I like the idea of their online communities. I guess the thing is, like, does it have to just start with nothing? Can it start with something? Like, can it be like a like-minded group of people that are interested in, like, can it be a book club? Can it be like coalescing around a popular Twitter account? Can it coalesce around an idea like, longevity or, transhumanism? Like, it just seems like they start as BS, and then, 1 in 1,000 of them become a large enough community that can raise VC money and launch products. Like, I just think, like, I get what you're saying, but I just don't see how it's from how do you scale Web3? It's like, yeah, okay, a bunch of random people use pump.com or whatever to launch some nonsense, and then 1 in a million strikes gold. But for everybody else, they leave disillusioned by the whole experience. I think that's my concern.
No, for sure. Again, it's not ideal. I just the reason why meme coins typically build bigger communities is because there's no value to them at the start. It means that anyone can get in, right? Like the problem with, I guess the issue with something like EigenLayer, again, it's a totally different part of the market, but like its token's going to come out with like a $15 billion valuation.
Yeah.
So, like no one. I mean, they'll have tons of small holders that love the project and all that stuff. But for people to like make a lot of money on this thing, it's got to go to like 150 billion, 300 billion. If you're like just like a small holder of this that buys into it.
Yeah.
Whereas like meme coins, they typically start at like a 50K, 100K market cap. And so by the time they get to like a 50 million, $100 million market cap, you have like a community of like people who are so committed to the project, and so like fervent in their belief around the idea. And I guess what I'm trying to say is they build a more sort of devout community versus something that's more like institutional infrastructure. Again, I don't think it's going to work for infrastructure. Like anything where tech is like the core differentiator. I don't think meme coins. I don't think will have a chance, just because it doesn't really make sense. I think like if you're a really, really strong technical founder, like you're not going to just launch a meme coin first and then, hope that it gets distribution and then, get VCs to invest in you. It simply makes no sense. They'll do what projects for the most part have done, which is go the VC route. But I do think for the consumer layer, it might make sense. Like another one is this project called DeCode, which is a layer 3 built on Base. And it started as a meme coin for Farcaster. Farcaster is the big sort of decentralized social media protocol as well as app. Again, it started as like a meme coin for the Farcaster community. It got really big, and then now they've like backed into like launching their own layer 3, which has, I believe, a couple $100 million of TVL and like 100 different apps launching on top of it. So again, super early. I could be totally wrong, but I think for consumer apps and like L3s, which are, not, again, they're mostly focused on user facing than anything technical, but it might make a lot of sense. I don't know. I'm curious if you have a different take. I mean, the other
like kind of
could also go
take, I'm skeptical, but I'm a boomer, I guess. I just think, maybe they need to be rebranded. And, like instead of meme coin, community currency or something, because that's what they are, really. I don't know, maybe that's just, semantics. the reality that like the thing that I sort of observe about all of this is basically that, you know, people think like there are people who defend and meme coins as being like well, just a, you know, this is a byproduct of the democratization of you know, launching new projects and assets and value. I think that's where I land. You know, I defend their existence, their right to exist, and then there are people who are like proponents of them, and I just I just can't get there yet. But keep talking to me, and maybe I'll change my mind.
Yeah, no, I totally agree. I mean, I think there's also a counter argument. Sorry,
Yeah,
I think there's a counter argument too, which I kind of agree with, which is historically when meme coins have tried to become something, they sort of die out because
yeah.
they go from pure vaporware to, you know, not even vaporware, just like they lose their essence of being a meme coin. To,
It's like, you know, people want to be part of the community because it's goofy and silly, and maybe they can make some money, and then all of a sudden, it's, oh, we're going to use this as a blah 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 to do this, that, and the other. People are like, oh, that's no fun. I don't want to do that, right?
yeah, I totally agree. I think so. It is funny. I mean, again, that's why I'm not very. this is very low conviction forecast. The problem is I don't see anything else yet that makes sense. The only other thing that could be, yeah, I just don't see anything else that is kind of like is ready to take the mantle. Like maybe we could also be really early. Like this whole like points thing could go on for a while. And it's kind of similar to how like NFTs became this new way of launching a coin. So sort of like famously like Bored Apes, for example, which was I think the biggest NFT company in the world, just in terms of like Yuga Labs, which was the company behind it. I think they raised like a $450 million round or something. So anyways, Bored Apes is like this huge NFT collection. They actually also have another one called Mutant Apes as well. Both of which I think sold out and made tons of money. So Yuga raised money, and then what they did is they actually launched Ape Chain, which was going to be like I believe an L2, built as like a gaming focused chain for their community. It has not really taken off, to be honest with you. Like it hasn't really done much. So like from what I can tell, I think Ape Chain's live, but I haven't heard anything about it. It's not really like a chain or L2 that anyone's looking to launch on. So I mean, you can see both ways. Where like maybe if they just focus purely on being the best NFT collection instead of trying to like monetize by launching their own chain as well as like their own products and all that type of stuff, maybe it would have had more success. I mean, it's really hard to know, but I guess to me, like NFTs are one way of doing it as well. But the early returns on the NFT side haven't been too good. So we'll see. I think like, yeah, I don't know. I don't know what the next meta will be, but it'll be interesting.
When you do, let me know.
Yeah.
Oh, I've got an idea. You want to launch something, you draft a detailed document, then you file a prospectus, and then you get a regulator.
So,
and then you do
you
go public, and you sell it to investors who have had adequate time to do due diligence and have had disclosures and so on and so forth. There's an idea. Yeah.
So you know what's funny? I actually think that's the other alternative. So I think we're kind of at this path where it's like, are we going to like our project's going to go a more traditional route? The problem is it prevents you from really getting a big enough network size.
No, and also I suppose I don't mean to interrupt you, but like there's the benefit is that yes, network size, but also it's democratization. It's that anyone anywhere in the world can, you know, if they're part of a network and contribute to it, can be an owner in some way. They don't have to get rich from it. It's just like they can participate in the upside. And like I still think like that remains the most compelling thing about Bitcoin, ETH, and all the rest of these things, right? Sorry, go ahead.
So I think the only other, I totally agree, by the way, and I think that's part of the reason why, in a way, the industry has evolved is experimenting with all these different distribution strategies. I think the last thing, maybe the one other thing it could be, and we're starting to see a little bit of it with Monad, which we've talked a lot about on the show. I'll get the Monad, someone from the Monad team to come on the podcast as well in the next couple of months, because I think it's a project everyone should be focusing on. But anyways, I think one thing that's been interesting there is they've built one of the strongest communities in crypto for a project that hasn't yet launched. And what's interesting with them is they built a lot of like exclusivity into their community. So you have to be like an active member in the community. You have to be like a value add community member, whatever that's defined as.
Yep.
And because of that, and then also because of just like the underlying hype for the chain, as well as like I don't think anyone on their team has said this, but like this sort of general thought that like if you're a community member, you'll get an airdrop of their token, has meant that they're creating like crypto might go full circle to the point where just being a community member will give you an airdrop. So, which is interesting because like a lot of these projects have just given airdrops to people and then hope that they effectively become a community member. Whereas maybe the next meta is sort of like what Monad is experimenting with, which is where like just being a community member is what gets you the airdrop directly. And when I mean community member, I mean someone that's like really active in their general discussion forums, promoting them on Twitter, like bringing new people into the community effectively. That's like the only other thing I could see that might be the way like VC funded infrastructure projects, so like the high end of projects build their community. The only thing there is I'm not sure. I could easily see that being gamed in the sense like you could have like 100 different guys in somewhere in the world with like 100 phones on like a on a rack or something, just like saying hi to everyone in the Discord or the Twitter. So it could easily be like cyborg a bit. So I don't know. But anyways, that is kind of like the only other approach I see that makes a lot of sense.
Yeah.
So we'll see.
Well, I mean, we shouldn't like maybe just end on it. These other distribution methods have actually been really successful in other ways. I mean, like the mining model worked really well for Bitcoin. It's the biggest network in the world. The ICO model, I mean, Ethereum in effect did a sale of tokens, and it's now a platform that's worth $400 billion and is the platform that's where the most innovation is happening and the most application development, right? IEO, I guess BNB is an example of one of those, right? In a way, they did it on their own platform. And I mean, look, like by value creation for unit holders, that as the metric, that's worked out really well too. What else? Liquidity mining. Well, there's a lot of projects in the DeFi world that are still top 20, top 30 projects that got big that way. And airdrops like Uniswap is the example you provided. I mean, it's, in my view, the poster child for how DeFi can scale and be like really meaningful. So like in a way, none of these models have failed per se. They just have shown their weaknesses, and people continue to iterate and innovate, as is the nature of this industry. We're going to keep on doing it, trying new things and throwing new spaghetti at the wall. And we're going to be there to track it all. And if I don't understand something, I will ask you. And we'll just keep on chatting through the crazy wild world. We were supposed to have a guest this week, by the way. This person unfortunately got sick, but they'll be rescheduled for another date. But yeah, like I've said in the past, we've got some great guests coming up. Please don't forget to like and subscribe to this podcast wherever you get your podcasts, Spotify, Apple, YouTube, you name it. And we'll see you next time. Andrew, thanks for a great chat. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.